The probability of closing a large gap. Our research team decided to take a look at different gap sizes. We're gonna do another study with like a 1 standard deviation move, but we started at the large gap, which is a 2 standard deviation move, something that happens about 5% of the time. What is the probability of, if we open up 2% or down 2%, that we come on and we at some point come back and go the other way? Let's take a look. So recently, we've seen an increasing number of stocks that experience large one-sided movements. Whether or not there is an earnings, Boeing, obviously, when the 737 MAX stuff came out recently, you saw a 2 standard deviation move. One stock like 260, 255 or something opened at, 220 or something like that, or whatever the move was, over 2 standard deviations. What are the chances it turned around? Well, so far it hasn't, but let's take a look. Next slide, please. So we do wonder, how often and how quickly should we expect to see the stock price come back and fill the gap after these extreme moves? Now, when I see an extreme move, I do not think they're going to come back and fill the gap right away. But the question is, at how far? Like, is 1 standard deviation enough of an extreme move? Because we've seen plenty of those come back. But is 2 standard deviations, whatever, how often will they come back? And how accurate are these, measures of 1, 2, 3 standard deviations? How often does this stuff work? Let's go next slide. So to understand this, we conducted analysis on 20 liquid companies in the S&P 500 over the past 5 years. We isolated instances where the underlying price moved 2 standard deviations from the previous day. So that means an overnight move or intraday or overnight move of 2 standard deviations. So this means that the current price is 2 standard deviations away from the price the day before. We then tested the likelihood of the stock filling the gap within 1 day. Let's go to the next slide. In a truly random market, we would expect approximately 5% of all the occurrences to have plus or minus 2 standard deviation moves. So theoretically, there should be a 5% chance that the gap will be filled the next day. So realistically, how frequently do we observe a price movement that completely reverts after a 2 standard deviation shift? What do you think, Pat?
Oof. Not reverts after, in what time frame?
1 day.
Oh man, I think it's got to be low.
All right, let's take a look. Next
2.5%.
Next slide, please.
What do you think? Have you seen it?
Yeah. So in practice, we found that the gaps on both sides were filled roughly 5% of the time within 1 day, which is in line with the theoretical suggestions. Additionally, there appears to be a slightly higher chance for a gap down to be filled, meaning the market has a tendency more often than not to rally back up from gap downs. But just like Tony said, to about 2.5%, because that would be 2.5 and 2.5, it actually turns out to be up days, there's about a 2% chance they will turn around to the downside, and down days, about a 3% chance they will turn around to the upside. Now, we don't have a lot of 2 standard deviation moves, gap ups in the S&Ps, but we do have a lot of 2 standard deviation moves in different equities. Like for sometimes, like you said, for earnings, like the Boeing move, things like that.
Sure.
So if you really want to know, at what point do you want to be a contrarian with a plus 2%, with a plus 2 standard deviation move? It's probably not a great risk reward. So on gap ups, you have about a 2% chance of it turning around, go down, and on down moves, you have about a 3% chance of it turning around to come back the other way on a 2 standard deviation move. Let's go to the next slide. Next, how would the probability change if we extended the duration? So to explore this, we compared it to 5 days and 45 days. Obviously, the chances are going to be greater.
Sure, more time.
But let's see by how much. Next slide, please. So the probability of filling the gaps increases quickly if you add duration. we found that in more than 50% of the occurrences, the market eventually returned to its original price before the gap within a 45-day cycle. It's amazing that 60% of the occurrences filled the gap in 45 days, and 20% filled it within 5 days.
Mm-hmm.
Yet within 1 day, still only 5% total. Pretty good numbers.
Which is what you would think the numbers would be, right? I mean, that's
Yeah, the 5%
about the
number makes
chances
sense,
of us
but
standing
5
again.
days at 20% still feels a little high, but I don't know. Pretty good stats. Let's go to the next slide. This also confirms that neutral option strategies like strangles and condors, they have a higher probability of surviving large moves when using longer durations, such as 45 days. This also applies to contrarian plays, but now you can understand why that 45 days is interesting to us, because it gives you time to be right, because a lot of these trades come back. And let's go to the last slide. So the takeaways. The probability of experiencing large gap reversals, such as 2 standard deviations, appears to be independent from other factors and aligns with theoretical figures. So utilizing longer expiration cycles increases the possibility of profit for premium sellers, including neutral strategies and contrarian plays. I think we just laid it out. You go from, if there's a huge move, it goes from 5% to 20% for 5 days to 60% in 45 days. So the whole thing with us is always extending duration and give yourself time to be right.
very good, sir. Let's take a quick 90-second break and come back. We got more Tasty Live. The Russell has joined the even the S&Ps and the NASDAQ to be ever so slightly down $4.70. Only the Dow is up 70. We'll be back in 90 seconds. It's Tasty Live. Opening bell.